Now time to zone in on investment strategy and how the markets, taking a glance back at how the markets have performed year to date and what we're likely to expect for the rest of the year. Paul Hansen from Stanlib and Mike Estment, CEO of NFB, joining me now in studio. Paul, I'll start with you. Just some observations from the year. We've got sentiment amongst global fund managers sitting at lows back that we saw in 2011. We've got cash on the balance sheet sitting at highs, sitting at 5.3%, the third highest on record. We've got commodity prices falling back. Oil, of course, falling back quite dramatically from 128. Yet equity markets, especially in South Africa, sitting near record highs. I mean, how do you price the two together?
Strong country. Now look, our financial industrial index has been fantastic. The mining index is trading where it was 5 years ago, so it's struggled. Down so far this year, about 5% total return, but financial industrials remain in a magnificent bull market, no matter what, although things are very pessimistic out there, they are. Part of it is to do with some great offshore businesses that we have listed in South Africa, including British American Tobacco, Richemont, SA Breweries, which only does 40% of its business here. You know, it's the biggest share in the industrial index. It's about 18% of the industrial index, and it's doing most of its business in emerging markets outside of South Africa. So, you know, we're lucky that our investors have access to such top quality global companies that are not necessarily, you know, feeding off South Africa's economy.
And of course, the likes of Richemont very much geared towards the Asian luxury market.
Very much.
Yeah, and that's, you know, that's been obviously fueling demand for that stock.
Absolutely, and British American Tobacco, the same thing. It's probably 99.9% outside South Africa and beating the FTSE 100 index hands down for years. And, you know, we're lucky to have that because that's helped power our stock market.
Mike, what are your views on this in light of the fact that we've also got the interest rate environment to look at and the impact that that's had, for example, on the bond market, so the bond versus equity play that we're seeing?
Well, if you look at the comments that Paul just made, they fit perfectly into the interest rate story, because interest rates in South Africa for investors offer yields of around 5, if you're very lucky and very, very wealthy, 6%. After tax, that's 3. Dividend yields on top stocks are competitive with those numbers, and that's after tax, because there's a withholding tax on the dividend. But they, you know, 3%, you then just bank your money and wait for the market to perform, which might be longer. You might have to have deep pockets, so you can't take sort of money that you wanted to deploy into the purchase of a house or a business or some cash flow and stick that into the markets, because they are very, very volatile. But certainly cash is not king right now.
So in terms of that asset allocation conundrum that we're always looking at, if you had to have that 100 Rand, how would you be advising one to allocate it between equities, bonds, cash, and say perhaps property?
Well, I think that property is probably one of the great assets of the last century. If you look at global sort of reality, is that people invest into their own home. That's got to be a good idea. The timing of that can be interesting, but over time you will be rewarded. Equities, on the other hand, are very volatile. They need time, lots of time on the block to make sure that you get a superior return. The beauty there is that they're inflation linked, so the earnings yield will increase over time. The price of the stock will be linked to inflationary pressures, whilst fixed interest isn't. So interest is taxable. It does not offer you any capital gain at all. You just get a yield on your money, and if the market actually happens to, like the globe is in the sort of zero interest rate environment, South Africans are defended against that, because at least you can get 4 or 5% on your money. Overseas, you can get nothing, which also fuels and speaks to the equity markets overseas starting to look like something where value will be offered.
What are your views on that? Because South Africa's market as an emerging market versus its peers in global emerging markets is considered relatively defensive. And that's because of quality metrics. I don't know if you want to run through some of those. But what is your view on South Africa's relative perception on the global equity front?
Yes, South Africa, although our country has a much slower growth rate than the rest of the BRIC countries and a lot of other emerging markets, slower growth rate than Africa,
and high unemployment, of course.
And very high unemployment. Which is our biggest problem, nevertheless, our companies are highly regarded. The management of South African companies, I mean, you take a company like SA Breweries with the same old South African management transporting itself to London and operating on the global stage as if they'd, you know, always come from the top drawer, competing so well. So our management is highly regarded. The corporate governance, we are first in corporate governance in the emerging market universe. So when analysts and fund managers come to speak to South African management, they often say, look, they're a bit more believable than the average management of emerging markets. So we are regarded as more defensive from that point of view, even though we have a lot of resources in our back pocket.
Yet you say, Mike, that it's probably time to start looking offshore when it comes to equities.
I think diversification is always a good idea. So to be highly focused specifically around your own geography could be argued is naive. South Africa has been constrained historically by exchange controls. Those have been significantly lightened up, and it allows one a genuine opportunity to sample, for instance, Paul mentioned the resource stocks and retail and industrial and airliners and banks. You're not constrained now to the South African universe only. You can in fact buy world-class counters in sectors where South Africa doesn't lead the world market.
When it comes to dividends, that's been considered one of the key factors one has to look at in a point of time where you've got a market trading sideways, many shares trading at P's that are extremely low, like right now, Anglo's obviously coming to mind. Global emerging market average dividend sitting at 3.1%, in South Africa dividend yield sitting at 3.6%. Are you strongly focused on companies that have high dividends, Mike?
Well, I think that anybody commenting on markets would say that in the type of market we sit in at the moment, where price volatility is the name of the game, where the outcome in short to medium periods is not sort of cast in stone, is earnings is absolutely critical for two reasons. One, you can bank them. Two, they can be tax efficient. It depends on the jurisdiction. But three, you've actually got a lousy competitive interest rate environment that you're competing against. So you're in a real asset class, and high dividends probably will translate in the years to come for those shares outperforming shares that don't have a clear dividend track.
I know that you focus in on Sir John Templeton's comments and his investment philosophy. Why do you think that he's got it right and he's got the right investment philosophy for a market like this?
Well, he was a great value investor. He died a few years ago at the age of 95. He started the Templeton organization, which merged with Franklin, and he had a fantastic investment philosophy. You know, he was a billionaire. He's successful, very successful investor and very successful philanthropist. So he had these amazingly wise sayings that he brought in over time about how, you know, bull markets start amidst massive pessimism, they grow on skepticism, they mature on optimism, die on euphoria. And right now, I think we're in the skepticism stage. Everyone looks at our market and said, can't be, ridiculous, how can we be at record highs? Look, the world's falling into a big heap. And they said the same thing 3 years ago, in 2009, August 2009, when the market was recovering. People said, can't be, we're in a great recession. So, you know, I just remember some of his sayings, and they bring one back to sort of a certain sane reality. You understand what's happening, gives you a bit more understanding of what's happening. Now, also one of his favorite sayings was, he said, people often ask me, where's the best place to invest? He said, but that's the wrong question. You should be asking me, where are prospects looking bleakest right now? Because that's where you're going to get the best values in real estate, in shares, etc. Because those prices will reflect that.
Okay, so your views on that then, because then of course we're going to ask you that question: where are prospects looking bleakest? Where are investors pricing in perhaps an Armageddon type situation, a bad situation that is probably won't play out? Well,
Greece, Spain, Portugal, Ireland, you name it, those places jump into mind. So, you know, you've got to think that there's some great opportunities out there.
So where are the opportunities? Tell us about the stocks right now that are looking most exciting to you, that are really trading at discounts which aren't warranted.
No, I'm not the right guy there. I don't pick individual shares. Okay, I pick funds. So I'd probably be looking at a fund, a Spanish fund right now with the interest. I'm a bit concerned about Greece because it might not stay in the euro. So if it goes to drachma, you get a 50% depreciation of the currency. You know, you've got an automatic hamming negative story there, but I don't think Spain will leave the Eurozone. So I would look at Spain quite closely.
What are your thoughts right now on that, on the Eurozone situation and how that, okay, we're not going to ask you how it's going to play out, but there is, of course, Templeton coming with his wisdom of many years and saying that history does repeat itself and you know, you have this herd mentality which impacts prices, but aren't we in a situation which is completely unique to the world and we really don't know how this is going to play out, and how do you invest in that?
Well, you know, I think Paul's right, and we've been, our business has been a value play, sort of a more conservative than aggressive investment vendor and product provider. However, Japan would have probably looked 15 years ago as an absolute dead cert, and for 15 years after that, it's actually been in these terrible lows with low dividend streams, with zero interest rates. The funny thing is you could invest in yen and earn almost nothing, but buy the car for 3% or 4% less next year. You don't pay tax on the discount you get on the car. That's called, you know, sort of deflation, which is horrible to think about. It's not good for the young people in Japan, but for older people with money in the bank, at least they're getting the car for, and they're not having to pay tax on the discount they're getting because of economic uncertainty and woes. So I'm not as bullish in terms of the euro story just yet, but there will come a time, and it's about trying to find that time. The way to resolve that conundrum is to sort of say, well, let's put our funds in a slow, controlled fashion over time and make darn sure that the money is available for the long term if you're going to play in equities.
And what about the oil price? Because the oil price was at 128 at one point this time, and all we talked about was the inflationary impacts, perhaps the impact that it will have on global growth. And now it's at around $92 today, $90 yesterday. How's this going to impact investments and markets from your side, Paul?
Very positive for everyone having to buy oil. Not so good for the oil producers, not so good for Sasol, but fantastic for the world. It's like a tax cut. Well, look, we've had the tax hikes as the petrol price has gone up, but now with the oil price coming down so sharply, you think of the US, it has a huge impact on the consumers there because it goes straight to the bottom line, straight into the pocket. You cut your oil price, your petrol price there, because they're in dollars, by 25, 30%, and it has along the way, it'll have a very meaningful impact, positive impact on consumers and businesses.
So positive for equity markets, risky assets.
It is. It's positive for...
Ultimately.
It is very much positive. In fact, it's not just oil. It's the whole commodity complex has come down by 25% since April last year, including food. And that's very positive. That's hugely positive for emerging markets who buy a lot of their food and or use more of their food, more of their annual wages for food. It's very positive for companies using those as raw materials. It's actually a good story that's being hidden by all the bad news.